Well, hello, everyone, and welcome to the Benjamin Z. Miller Investor Networking Group. It is so good to see everyone here today. It is wonderful to see the audience. We've got such a good group that's here today, and we have such an exciting topic for today. Today, we're going to be talking about an area of real estate that's called net lease real estate investing. Now, many of you are already very, very familiar with residential real estate investing, where you might buy a property, maybe a house, and then you're going to rent that house to a tenant. Well, there's no reason that you can't do this with a big building and rent it to a big company. So with that, we're going to go ahead and talk about how that works, the advantages, the disadvantages, and I'm also going to mention some ways that you could profit from this easily if you're not a passive investor. All right, so let's get started. So single net, double net, triple net release investing, single net, double net, triple net real estate investing. What is that? Well, folks, that is where you have a building and you're going to lease the building to a big company. But unlike a normal situation where you have a tenant and that tenant can call you and that tenant can say, hey, the roof has a leak. I need you to fix that leak, Mr. Landlord. Or maybe the tenant can call and say, hey, something else is not good. With this type of net lease real estate investing, you can potentially, depending on which sort of net lease it is, remove yourself from some or even all of those responsibilities. So that is a very exciting, wonderful thing with this. So the first thing is the single net lease, and this basically requires the tenant to pay only the property taxes. So that's not as good from a landlord's perspective as a double net lease, because if you get a double net lease, the tenant pays the rent and they also pay the property taxes, as well as they pay the insurance on your building. Or if you do a triple net lease, in that case, the tenant has to pay the rent, they have to pay the insurance, and they have to pay the taxes. So that is wonderful. And here is a chart that shows exactly how it works. This chart here basically provides a breakdown of the different lease type and what the tenant responsibilities are. So, single net, double net, triple net. By the time you get to triple net, a lot of things are on the tenant. If you're on a single net lease, you as the landlord, you still have to deal with some things. But there's even a higher quality lease where it is such an interesting lease. It is called an absolute triple net. And that's even more powerful than a triple net. It's also called a bond lease, and it's also called a hell or high water lease. And with this type of lease, the tenant is responsible for all of the expenses and the repairs relating to the building, including the roof and structure. So if you have an absolute triple net or a bond lease or a hell or high water lease with your tenant, and the tenant calls up and says, hey, the roof's leaking, you are within your legal rights to say, well, you better get that fixed. You better get it fixed fast or you're in violation of your lease. So that's how it works. Basically, you can offload responsibility onto the tenant. And these are some interesting leases that a lot of people are not familiar with, this type of lease. So why is net lease potentially better than a bond? And when I say better than a bond, I need to clarify that. I'm talking about it's better than an investment grade bond. I'm not talking about it's better than a private company bond that, for example, if you're talking about an emerging market bond with a company like Andesite Blue, or if you're talking about, say, Alamo Mortgage Holdings, a company that is securing their bonds by hard assets, they do even better in terms of the return than a net lease. But if you're just comparing an investment grade bond with a net lease, in that case, net lease is going to win. And we'll go through how that works. Net lease gives depreciation for your tax return to offset income. You don't get that with some investment grade bond. That bond salesman that sold you that investment grade bond, he may have forgot that you don't get any depreciation on it. Compared to real estate, he may not have discussed that with you. So if that's a situation, if you're watching this video and you've got a bond portfolio, you should call me. Call my company, reach out to benjaminzmiller.com, and we can talk about some options for you that might be interesting. Another thing that's nice is with net lease, you actually own something. You own that building. Yeah, it may be you and some other investors, but you own it. You're an owner. Whereas if you just have an investment grade bond, you really are just lucky if you get your interest back. And a lot of people, they define an investment grade bond as it's a bond that's issued by companies or governments. It's usually big companies. And they have a credit rating agency that goes in and says, oh, I'm going to give you a high rating. Maybe it's Standard & Poor's, maybe it's Moody's, maybe it's Fitch. And a lot of investors, the mistake that they make is they just love these rating agencies. They just think that these rating agencies are going to make their life so simple where they can sit in their comfy chair and they can sit back and say, well, it's got a good rating. I'm a smart investor. I know what I'm doing. Well, folks, I want you to read about the history of a company called Enron in Houston, Texas. And these sorts of rating agencies, the ones that everybody nowadays just seems to talk about like they are the best thing when making a decision, they were giving great ratings to that energy company Enron. And guess what? Guess what, folks? There were some accounting irregularities that were discovered. Those always seem to come up, the accounting irregularities. And guess what happened? Those bondholders got wiped out. They just got wiped out. And they were so shocked. They were like, wow, I didn't know that could happen. Yes, you have to actually do your own due diligence, folks. You can't just sit back on your comfortable chair and assume that a rating agency is going to protect you. And a lot of investors, they don't like that. They wish it could be so easy because they're so excited about their trading on their keyboard. They saw it go up. They're going to sell. Folks, that doesn't do any good. It's just burning up money and transactional fees. But with net lease, you've got a huge advantage over those guys. You know, you're miles ahead of them. But if you really want to get on a rocket ship, you should contact Benjamin Z. Miller. Just fill out the contact form, benjaminzmiller.com, because we've got bonds that will exceed even a net lease. But I want you to understand what a net lease is. So they run for about 10 to 15 years. So what sort of companies do these sorts of leases? Well, I mean, there's Walgreens, there's Rite Aid, Target, Starbucks. Everybody just loves Starbucks. They're going to go in and get some of that overpriced coffee. They just love it. So Starbucks, they want to just be a tenant. They want to be a tenant, and they do that. So, you know, a lot of companies do this. And the arguments that they make is they say, well, renting provides flexibility. It allows companies to easily relocate. Yeah, those are all reasonable statements. And they're great statements if you're an owner of a commercial building. That is music to your ears. You love it when someone just wants to rent your building instead of buy it, especially if it's a credit tenant, because that's as good as getting it sold in most cases. So that is how it works. Now let's talk about what is it that exactly makes the value of a commercial property. Well, unlike residential real estate, where you use comparable sales, in residential real estate, you say, well, house one sold for $100,000, house two sold for $120,000. So I think that the value is $110,000, you know, you figure it out on a per square foot basis. But basically, that's how you do it, a comparable sales approach. But it's totally different in commercial real estate, completely different. You would only use a comparable sales approach in commercial real estate if you were dealing with buildings that were vacant. So if you had a vacant commercial building, then you could go and look at other vacant commercial buildings where there's no tenant and use a comparable sales approach to determine the value. But if the building is producing income, if your building has a tenant that's paying, then it's determined by the net operating income and the price of the property. So Let's imagine that you have a property that has a net operating income. And just to review, net operating income is where you've got your rental income, and then you're going to subtract your taxes, you're going to subtract insurance, different expenses, but you don't subtract a mortgage. So if the building has a mortgage, leave that off the calculation, but you get the net operating income. And let's imagine in this example that the building, say the seller is asking 1 million for the building. Well, if it's producing 50,000 in income and the seller's asking 1 million, it has a cap rate of five cap. When you divide it, you get a 5 cap. Or if it's 100,000, say it's producing 100,000 in income, it's a 10 cap or 0.10. And you want to compare the seller's asking cap rate with the market cap rate. Because sometimes, and this is particularly true when you have a seller that's selling his own building without a qualified broker representing him. Sometimes that sort of seller will decide that his building needs a real low cap rate. He's got all sorts of reasons for it, but you want to compare the market cap rate to what the seller's asking cap rate is. And if there's a difference there that's not in your favor, it's okay if there's a difference and it's in your favor. But if it's not in your favor, you want to bring it to the seller's attention and say, hey, this is crazy. You do this diplomatically though. So in general, with cap rates, high quality assets with high quality tenants, they're going to have low cap rates. Bad assets with bad tenants, they have high cap rates. So let's imagine a high cap rate, okay? And this is something that trips up a lot of new investors, because when they figure out how the calculation works to determine a cap rate, the next thing there's like a light bulb that goes off in their head where they're like, wait a minute, if I buy a high cap rate asset, I'll get more money. And then if they haven't really thought it through, or they don't have proper education, they're going to be like a dog that's out there running around trying to chase high cap rates. And that always ends badly. Because when you move to chasing higher cap rates in investing, you are going to take riskier and riskier deals. Now, let's imagine something that's a situation. Imagine you've got a wonderful California investor. Maybe he's someone that's super successful, lots of money, and let's say he's a high-paid surgeon, for example, in California. Maybe he's a plastic surgeon and he's making all sorts of money. He says, I've got a lot of money. I need to invest in real estate, because he knows that he should invest in real estate. He understands that much. Then what he does is he thinks, well, I should buy things that have a good net operating income, that have a high cap rate. And he gets presented with a package of 20 rental homes in a undesirable neighborhood. Undesirable neighborhood means maybe a ghetto, maybe where there are shootings occasionally on the street, maybe where there are drive-by shootings. And since he's in California, he's like, well, I'm just going to get a property manager to manage it. And he buys it. And then he sends his property manager out to manage it. And the property manager comes back and says, oh, I couldn't collect any of the rents. I was scared to get out of the car. So then the next thing that he does is he has to get, maybe security. And it becomes a big mess, because he saw on paper how it worked, but he's not the old seller. So chasing a high cap rate's dangerous. Whereas if you have a low cap rate, that can be very stable, very dependable income. Because imagine you have a low cap rate, which you would see if Starbucks was your tenant. You're not going to see a 10 cap rate if Starbucks is your tenant. You would see a low cap rate, but you're not going to have any problems. You're going to get that rent money on time. So that's important to know. And that's a mistake that really trips people up. Basically, if you look at a multifamily deal where it's maybe a big apartment community, and let's imagine that apartment community is, say, in San Francisco, California, and it could have a cap rate. If it's a premium new building, really high quality, it could be range between 2 and 5 cap. But a package of houses in the ghetto, you could see a 20 cap, you could see a 25 cap, and buyer beware. God help the one that makes the mistake of buying that and then decides they're going to go collect the rent themselves because the property manager won't do it. And I have heard of investors actually getting shot when they did this. I was at a club in the Dallas-Fort Worth market, and there was a situation where someone had inherited some of these properties. It was an older woman, and she got actually a deputy sheriff to go and collect the rent. And guess what? He got shot. This is a deputy sheriff that was collecting the rent. So don't chase high cap rates unless you really know what you're doing. Okay, so here's an example. We're looking at an asset here in McDonald's. And this is a real asset. This is in Florida. It sold for $1.659 million. And notice the cap rate was 3.85%. So the income the property generated is you multiply the price by the cap rate. This was generating $63,872 in annual rent. So if you were to buy this building, then I misspoke there. There's a mistake on the slide. I'll correct it. It generates $63,872 in income. It doesn't generate that in rent, because the rent is actually, that should say income, but it says rent. But the point is, you're going to get paid $63,872 there. And if you were to buy the building, you would receive income of $63,872 with monthly payments of $53.23. And you can see it's a low cap rate, high quality building, looks brand new. Now let's talk about a low quality tenant. And we have here a beautiful example. And this is a great example of why you don't want to chase a high cap rate. So this is a real asset. This is in Texas. Look at that cap rate, 25%. This has a 25% cap rate. So what does that mean? That means if you theoretically, if you paid $800,000, you would receive $200,000 in income if you bought this asset. Every year, you're supposed to receive $200,000 in income. Now look at that building there. Does it look like it'd be easy for that building to pay $200,000 in rent? Do you really think that can produce $200,000 in rent? I mean, it's not in a big city. It's in Corsicana, Texas, but it's got a 25% cap rate. And here we're about to see the example of the dog investor that is going to chase that, and he's going to end up, if he ends up buying it, potentially with a headache. So this is saying that you're going to get $200,000 in income. And if you were to buy the building, you might actually get paid $200,000 with monthly payments of $16,667. But your tenant is not McDonald's. Your tenant is not Starbucks. Your tenant is someone that owns a fireworks stand. Now, fireworks are seasonal sales. They don't sell those around the year. There's usually maybe 1 month where the sales are real good. And if you were to buy this, it's possible that the tenant would make 1 or 2 payments and then tell you they have a business problem and leave. And you're like, wait a minute, I just paid $800,000 and now you're telling me you got a business problem and you're leaving. Well, I don't understand that. What about the $800,000? And then the tenant is like, well, the fireworks business isn't working out. I've got a situation, I'm gonna move. So then you lose. So the point is, be careful on chasing high cap rates. It's real important to avoid that. And now right here is the most valuable thing in the entire presentation, because this is going to teach you something that probably 99.9% of people that are out there don't know about real estate investing. Let's look at this vacant building. Okay. That building, when it's vacant, the one on the left, it would be valued by comparing to other vacant buildings in that city. approximately the same size. What did they sell for? And guess what? Vacant buildings sell for cheap prices because nobody wants them. Who the hell wants a vacant building where all you have to do is throw more money at it and more energy getting a tenant? So it would be valued at theoretically 400,000. Now let's imagine you bought this vacant building because you've got a plan and you're sure you can do this. So you buy it and you advertise it for lease, and out of nowhere, a guy in a big plumbing truck pulls up. It says Joe's Plumbing, and it's a brand new truck, and the guy has, you know, a name tag that says Joe's Plumbing, and he's, you know, he looks pretty professional. You know, he looks pretty professional, and he says, I need this building. I want this building for my company, Joe's Plumbing, because we need area for our equipment. We need places for our people, and it's big enough, and I want it. And then you say, okay, Joe, if you want this building, it's going to cost you $10,000 a month. And Joe says, all right, I'll do it. Can I, how much is the deposit? You work all that out with Joe, and he moves into the building. Joe makes payments for 3-4 months, whatever. He's making payments. He's got possession of the building, and you are happy because you're getting $10,000 a month. And then you call up your real estate agent and you say, hey, I've got Joe in here, and he signed a 15-year lease. He's paying $10,000 a month. It has rent increases every 3 years or 5 years or whatever it might be. And I want to sell the building. Well, guess what? Because that building is now producing $10,000 in income, you can sell it for $800,000. Now, hang on a minute. All that happened there was you had somebody sign a lease and move into a building, and you're saying that increased the value by 400,000? That is exactly what I'm saying, folks. That is exactly how it works. But now let's run that same scenario again, and let's say you hit the jackpot. If any of you like to go to Las Vegas, I don't go to Las Vegas or gamble. That's not for me. But if any of you like to gamble, let's imagine that you hit the jackpot. You got your building out there, and right before you're about to sign the lease with the plumber, you say, I'm going to think about it. All of a sudden, a Mercedes-Benz pulls up, and it's got some guys from Dollar General in it, and they're wearing suits. And they say, we want this building for a Dollar General. And you say, well, guys, okay, what do you want to do as an offer? And you guys talk about it, and they make you a beautiful offer also of $10,000 a month. So you call Joe up and you say, hey, Joe, listen, I can't lease it to you because I've got a situation here where another tenant wants it, and I'm not going to be able to lease it to you. And I wish you good luck. If things don't work out with them, though, I'll call you back. And then, you know, Joe goes away, and then Dollar General moves in. Now you have a big publicly traded corporation as your tenant. And guess what? Publicly traded corporations, they don't get divorced. They don't get on drugs. They don't just wake up one day and decide to leave. They don't wreck your building if they get angry. They just behave in general as professionals. So they're very desirable as tenants, and they have an incredible record of always paying on time. So it's very rare to find a publicly traded company that leases real estate and pays late. So now all of a sudden, your building is going to be valued at the cap rate for Dollar General, and Dollar General happens to have a very low cap rate. So when that valuation is performed, you had the best day ever. With that one lease, the value of your building jumped from 400,000 to 1.6 million. So you went from 400,000 to 1.6 million in 30, 60 days as a result of that. And the best part is you can walk into any bank anywhere and say, hey, I've got a lease with Dollar General. Give me a big chunk of cash. Give me 500,000. Give me 800,000. Give me $1 million, whatever it is. And the banker is going to do it in all cases. I mean, unless there's some reason where maybe the bank doesn't have money, but you could go down the street to another bank. You can easily get cash out of it. So you are on easy street, and you may get lucky where after 15 years, they decide to lease it again. And that's actually quite common because they've been operating there for 15 years. They'll lease it again. So these are the sorts of deals that can really change your life and really make things better. And here's what I was going to mention here, because I want to really share some valuable information. You don't actually need any money to do this. If you're not interested in buying these assets as a passive investor, if you could find a vacant building that was in an area where publicly traded companies wanted a building, and if you could work a deal out with the owner to purchase the building, or you could even do it with what's called a lease option, using paperwork, you could control that building for a period of time, maybe 90 days or something, whatever. And you theoretically could do this without even putting any money down, just a nominal deposit. And then if you got on the phone and you called Dollar General, you called maybe 100 other big companies in the area and say, hey, I've got a building for you. It's perfect for your brand. It's perfect for your location. It's right next to what you're looking for. It's got everything. Let me show it to someone from your real estate department. Someone from the real estate department comes over and you say, here's the building. I'll lease it to you for $10,000 a month. If they agree to do that, you have just basically done exactly the same thing, and you haven't even bought the building. So that is possible to structure. You have to get the paperwork right, but you can do that. So it's kind of a neat thing that a lot of people don't know about. So why net lease? Well, it's one of the most reliable forms of income. With it, when you have a net lease, you're dealing with a strong credit tenant normally, like McDonald's or Starbucks, and your rental income comes in reliably. Now, let me comment. You also can have net lease where it's not with a publicly traded company, where it's not with a big company. You can do a net lease with anyone. You could do a net lease with Joe the plumber. You could do a net lease with anyone, but that doesn't mean they're going to pay on time. Because Joe, maybe he'll pay for a few months until he gets a divorce or gets on drugs. Maybe he'll make it 3 or 4 years and then have a problem. But something could happen in Joe's life where his business collapses and then he can't pay. He may be a great guy, but he just can't pay. So that's not going to happen with these net lease deals. So they offer potentially, depending on how they're structured, they can offer virtually no landlord responsibilities or very limited landlord responsibilities. And in some cases, the tenant can often pay the taxes and the insurance and the maintenance. So here's an example of what one of these deals looks like. This is a real deal, and I'm going to show it to you. This was, let me go back here. Take a look at this.
When you purchase a net lease property, the normal way this begins is you submit what's called a letter of intent. And here is an example of the letter of intent. This was on a Dollar General that was located in Abilene, Texas. The price of it was $1.695 million, and earnest money was $10,000. And there was a 45-day inspection period, financing to be determined, and then it had some other things with the transaction costs. But this is how the process starts. This is before you have an actual contract. This is called a non-binding letter of intent to purchase, and it's your first step towards purchasing a net lease property. So I'm going to show an example of what this looks like. There's a company in the United States that's called Dollar General, and they actually have a lot of stores. They've got thousands of stores. It's a big corporation. And this was a deal that was in Abilene, Texas. And the seller, I was buying a property in Abilene, Texas. The seller was Dollar General, and it was located at 4325 10th Street. The price on it was $1.695 million. There was an earnest money deposit of $10,000. There was a real estate commission, and then title policy, recording charges, some legal fees. And basically this was the total on it. This particular property had a price all in, all the fees, everything, of about 1.73 million, 1.74 million. And, it was it was in Texas. Now, there was a lease that went along with this, and I'll show that lease here. Okay, so I'm going to show an example here of a lease. A lease is a contract to rent real estate. So this is a lease between Dollar General Corporation. They are the tenant. Dollar General is going to operate a store and then pay rent to the landlord. And the document I'm going to show you is a real document that's for a net lease property. So this basically, it says lease, and then you've got the limited liability company. You've got the effective date of the lease. You've got the name of the current landlord. This was actually the builder. So the builder was building Dollar Generals and then selling the Dollar General. And then here's what they look like. It's an extensive lease, and basically it has a lot of information in it where you can kind of look through, see what's the delivery date. The building is supposed to be completed in 150 days. Information on the tenants, what the tenant is going to be doing. The term of the lease is 15. You can see here where it says 15 consecutive full years. So it's a 15-year lease. It has the option to extend. And then here's the rent. So the rent is going to be $8,315 per month. And then if the lease is renewed, if the company wants the space longer, they have to pay higher rent. Then they have to pay $9,147 per month. And if they renew yet again, it can go up to $10,000 and then up to $11,000. Says that it has basically all of the details here. So that kind of gives you an idea of what one of those leases look like. This lease, just to kind of scroll to it, it's quite a document. It's about 60 pages, but it has all sorts of information in there, and it really kind of gives you an idea of what one of these looks like. Where you can see it's got a copy of survey, other things. Here's what it looks like. So that's enough on that.
So very good. That's what that looks like. And now let's go through this. Okay, our net lease deals syndicated. So just like you can syndicate the purchase of an apartment building, maybe purchasing a multifamily, maybe 100-unit apartment building, where you go and you get a loan for, let's say the apartment building, some hypothetical apartment building costs, whatever it costs, 10 million. You could go get a loan for 7 million, and then with your partners, you could raise 3 million. Well, you can do exactly the same thing on a net lease deal, where you could put a contract on a net lease property that say the building costs $1 million, and you say you're going to close in, 90 days or whatever time you negotiate. And then you could go get a loan for about 70%. So you get a loan for 700,000, building costs $1 million. And then you need to get 300,000. So you could structure that by offering limited partnership interests in the amount of 300,000 that you raise, maybe 100,000 from investor 1, 50,000 from investor 2, 50,000 from investor 3, and 100,000 from investor 4. And you've raised all of the money. And you can also put your own money in. There's nothing wrong with that. That shows how confident you are in the deal, and it's great. It's great PR. So it's common for these sorts of deals to be syndicated, and that's something that's important. So what sort of an investor is this going to appeal to? Well, these types of investments appeal to two categories of investors. So the first category would be older people that they have money. They don't want to put all their money in bonds or the stock market. They want something that is less volatile and that produces income, and that pays more than investment grade bonds. Net lease is a good choice in many cases for these sorts of investors. So they can participate in maybe one or more of these syndications as a limited partner, and they can get passive income, and they won't have to think or worry about anything for 15 years. So it's appealing in that sense. It also appeals to big funds. Lots of big pension funds, insurance companies, they love these sorts of things because they have a rock solid, safe place to put a lot of capital, and it pays more than investment grade bonds. So it attracts these sorts of things, but it's a bit of a different category. So Those are the two that are most likely. And if you don't want to invest into these and you just want to make money with them, if you find a vacant building that is a suitable vacant building, it doesn't do any good just to find a vacant building that nobody would want. But if you find a vacant building that maybe is vacant and you can use legal paperwork to tie up the building for maybe a period of time. During that period of time, when you have an equitable interest in the building, you can call up a bunch of big companies and you can say, hey, I've got a building for you. I'll lease it to you. And then they'll say, well, hang on, are you the owner? And you say, I've got it under contract. It's my building. I'll lease it to you. And you can say that, I've got a contract, you show them the contract, whatever. You're very likely to be able to pull that off. If you have the experience and the knowledge on how to select the correct tenant, how to explain it correctly, how to get them interested in it. And remember, if you were to get a 400,000 vacant building and you hit the jackpot where you got a credit tenant to sign a lease for $10,000 a month, that could potentially be worth as much as maybe 1.6 million. So that's a once in a lifetime deal if you pull it off, and it can make a big difference. So that is the net lease investing. That's the end of the presentation. I'm going to stop the recording and then I'll just open it up for any questions. I am very happy to answer all questions.